What is going on YouTube? Today we are going to be talking about oil, not the kind of oil that your dad covers you up in. We're talking about crude oil. Black as hell, tastes like freedom with an afterbirth of democracy. So, you may have noticed futures for oil, crude oil, absolutely ripping with this Sunday open. Up almost 7%. This is the largest gap that we have had since the C19 word. But why? OPEC announces surprise oil output cuts. OPEC, oil, petroleum, exporting countries. Oh, and while I have your attention, scan this QR code. You'll get free PCC. That's our social token. Learn to earn, baby. All the countries that have large oil reserves. So, this is how much they're cutting. Saudi Arabia jumped in. They're leading the pack. They're the single largest exporter in the world of oil. 500 million barrels a day. UAE, big numbers. Kuwait, Iraq, Algeria, Oman, Kazakhstan. So these are all the people who spontaneously, super quirky, decided to start cutting oil production. They announced it this morning. And this has major implications. I think this is what could be considered economic war. I'll elaborate on that. So, there's a couple key points in this article that I wanted. Basically, they hadn't anticipated this drop. Last October, they agreed to cut down 2 million barrels per day until the end of the year. And so basically, they were expected to do 5 million barrels a day, but they've cut all the way down to 1.16 million barrels a day. And the reason this has major implications for the U.S. is it is going to make their inflation a lot more sticky. Let's talk about that. So first thing, crude oil reserves, or U.S. crude oil in the Strategic Petroleum Reserve. So this chart from my charts, this is the max. This is the max time frame. It goes all the way back to 2018 when they started this stuff. And you can see quite clearly, under Fearless Joe's leadership, it has reached an all-time low. And part of the reason they did that is to hedge against the very high oil costs that were experienced in 2022 when the economy opened back up, right? Oil went back up to 125, and that is a price not previously encountered until you go all the way back to 08. And we know what happened in 08. We don't need to talk about it, though. So, oil, absolutely set to rip. U.S. particularly fragile because their reserve is so low. They only have, looks like 371 million barrels of oil. And given that these countries are pumping out 500 million barrels of oil a day, 500 million barrels of oil a day? That's something to think about. So yeah, everyone is basically turned into an oil expert now, including myself. Don't ask questions. I am expecting oil and energy to start to climb. With that in mind, there's 3 energy ETFs that I think are the most popular, the most liquid, and probably have the most to gain. XLE is just energy select sector. IEO is offered by iShares as oil and gas exploration. They're probably going to be exploring. And PXE is just energy exploration and production ETF. So those are 3 to put on your watch list. And if you do want exposure, you can do what you want because this is analysis and not advice. So with that, I'm going to go ahead and skip through some of these tabs that I wanted to show you. This is from a Twitter account, Kobayashi Letter. Super high level alpha. So on top of this oil insult that we're having from one side, there has been many other events to challenge the US dollar. Number 1, Saudi and China agreed on a new refinery, $12 billion project, massive infrastructure move. China and France settled a liquid natural gas trade in yuan. Russia considering using the yuan as a reserve currency. China and Brazil agree to use the yuan to settle trade. Saudi Arabia begins to consider using yuan for oil sales. BRICS, we all knew that was happening in the background. President of Kenya tells citizens to get rid of the US dollar. India says they will settle trade in the rupees with certain countries rather than dollars. Chinese yuan passes euro to become Brazil's second largest currency. IMF data shows now that Russia has 33% of all reserves in Chinese yuan. China and Russia agreed to use Chinese yuan as settlement currency. And then, also, we talked about it in another video, but the deal between Saudi Arabia and Iran that was brokered by China to sell their oil in yuan, that super significant. The Shiites and the Sunnis are now getting along. That never happened before. So, the two things that different sects of Muslim can get together on, fuck the US dollar. So, now that we kind of have the context of, hey, oil's about to get more expensive, these countries are delineating themselves from the US dollar, let's talk about the consequences. So I mentioned earlier that inflation is going to become quite sticky. And so if we look at these OPEC and OPEC Plus countries, basically OPEC is like the core group of friends, and OPEC Plus are the ones that you kind of see, but you don't really like. I'm not going to name any names, but maybe I'll highlight them for the ones that aren't in OPEC Plus, or aren't in real OPEC. You can see they don't move the same volume or size. And major implications. So Russia continues to restrict oil output to Europe as the war goes on. Russia typically nearly supplies 25% of oil imports to the European Union. Obviously, oil plays a big role in keeping your lights on and your food cold, and that's part of the reason why inflation is so bad in the European Union. Right? They don't have access to reliable energy, and ultimately, they have to pay a premium to get it. So basically, a buzzword here would be weaponization of energy. Weaponization of energy. So these are European countries. This is their current rate of inflation. Euro area overall rate 8.5%. The European Union itself 9.9%, right? Some countries way worse than others. For example, Hungary coming in at 26%, Estonia almost at 18%. But then you look at some others that are more mild. So for example, Finland's only 8%, Belgium's 5.4%. But the reason this is so concerning is because this is going to add an even further premium to the EU trying to maintain their energy demands. So overall, despite the quantitative tightening that is happening globally, I think this is going to make inflation much worse from a supply side. Yes, a lot of economic math, for example, core CPI or PCE, they purposefully exclude energy because they think it's too volatile. But inflation or energy inflation is still inflation. It doesn't matter if you exclude it from the core PCE if it's happening. So inflation from energy alone is currently at 13.7% in the euro area. Inflation from all items excluding energy is 7.8%. So it's super rough math, and I can barely count to 10, but I think that's 4.9% difference between inflation and inflation less energy. So you can see, very significant cause of inflation, because this is completely supply-sided, right? This has nothing to do with demand at all. So overall, crude oil, I mean, it's pretty hard to try and speculate where this is going to go, because any OPEC news could fundamentally break it, or break what we're seeing. But it looks like we definitely had good support there. And we're breaking out of the range, right? We were trading between, the swing high was like 82, the swing low was like 73. We were in this consolidation for 107 days. 107 days. So ultimately, it does look like oil is kind of breaking market structure here, right? We saw a series of higher lows, lower highs, bearish. So ultimately, it looks like that higher high is in progress, but if we start trending towards 84, then those ETFs that I mentioned, XLE, IEO, PXE, will all be looking really good. The reason crude is up so much and the others aren't, the crude oil futures, today's Sunday, April 2nd, so the market's opened a bit earlier, and so the main stock market where these are actually traded are not available yet. So overall, the US dollar currency war is ongoing. There is a lot of basically sanctions being placed against the US where countries are starting to delineate and de-dollarize themselves. And this OPEC cut is going to make inflation way worse in the EU because they don't have reliable access to energy now, but it's going to make it way worse in the States because I'm Canadian, but probably still going to feel the pinch here at the pump. The strategic petroleum reserves are so low, meaning they're going to probably want to refill them and they're going to have to pay a premium to refill them. In addition, they're in a currency war. So that's all I got to say. Thank you for watching. I'm your local economist that has no formal education, but I love to chit chat. Stay safe, take care.